Rising interest rates is hitting property markets worldwide. But Singapore property market is expected to stay resilient. Why is our property market defying the odds? Should you invest or hold back due to the rising interest rates? Let me share with you 5 reasons why Singapore property market is resilient. Reason number 1. Property is one of the best hedge against inflation. Interest rates is increased to tame inflation. Central banks want to keep inflation to about 2 to 3%. The United States is experiencing 9.1% inflation and Singapore headline inflation is 6.7%. Our research shows that property price move in tandem with inflation in the long run. Though we are coming out from a low interest rates environment, Singapore bank rates is still one of the lowest in the world. With rising costs in terms of manpower and material costs, prices only have one direction in the long run, that is up. Investors see that property investment is still one of the best asset class to park their money to hedge against inflation. Reason number 2, Singapore property market is not speculative. Many rounds of cooling measures have been implemented since 2009, lowering the loan-to-value ratio, introduction of seller stamp duty and additional buyer stamp duty, and total debt servicing ratio to ensure that buyers are not over-leveraging. These measures have ensured that buyers have holding power even if the rates are increased or the market takes a correction. Past cycles have shown that the market always rebounded stronger than the correction, and buyers can enter the market with assurance that their investments are going to hold its value and grow in time to come. Reason number 3, low supply and strong demand. Total number of unsold residential units is now at 14,087 units, which is a significant drop compared with 36,839 units in 2019. This shows strong demand and average market absorption is about 10,900 units per year. With recent successful launches of Piccadilly Grand, Live at MB and Amore, buyers and investors are showing strong confidence in our property market. This is backed by expansion in employment, the economy is recovering from COVID, and aspirational demand of HDB upgraders. Investors also see that the Singapore rental market is healthy with high occupancy rates and rental prices have been climbing since the opening of borders. Reason number 4, interest rate hikes impact is minimum for new homes. As new homes loan repayment is under progressive payment structure, the difference you have to pay is only from $26 to $386 per month, as seen in the table. The illustration is based on 1.5 million, 75% LTV and $1.125 million loan amount. New homes are always preferred by investors and homeowners given the modern design and first mover advantage. Investors can choose to sell their investment property 3 years later or convert their bank loan to fixed rates upon TOP. Reason number 5, ways to reduce the impact of interest hikes. While interest rates are inching up from the low rates of 1.5 to 3%, the increase in monthly installment is not doubling the amount. As you can see in the table, when your bank rates increase from 1.5 to 3%, your installment increased by $760 and not doubling the amount. Even if you want to reduce the increase, you can do partial repayment, extend your loan tenure, or use interest offset packages that some banks provide. Do speak to an OrangeTee agent to find out more on ways to reduce the impact. In conclusion, Singapore property market is expected to stay resilient due to the above 5 reasons. Do reach out to your preferred OrangeTee and Thai agents to find out what are your options. Happy house hunting!